Okay, folks, so one of my most revolting habits is I like a good deal. I don't want 20% off, no, not 30% off. I want the other person selling me whatever it is that I'm buying to be crying, because I know that if they aren't crying, then I will be crying later. And to be fair, hey, there's always some sort of reason that the goods or shares that you are buying are discounted. People don't give things away for cheap for no reason. And of course, understandably, the market has been very, very unable to find a lot of long-term buyers because of the massive global financial tightening and record high inflationary environment that we were in. But when certain big stocks and previous high-flying business models get beat down in excess of 80%, it's at least time to kind of think about them, right? Especially if you have insiders buying, big funds investing in them, and the stock is at least showing some proof of concept in terms of rebounding. And in this video, I want to discuss one stock that fits that criteria and is a stock that a lot of folks have been asking me to cover for the last few weeks. If you have a stock that you'd like me to make this type of video on in the future, comment it down below. And if you see another one that you like the comment so I know which ones are the most popular and in demand. But of course, Carvana is sort of a car e-commerce website where you can buy and sell cars online, and they handle all the shipping and everything. And this video is really the story of a stock who rode 3 massive trends before those 3 trends turned around and blew up in their face. First, they had the trend of COVID, where folks didn't want to go out to the dealership to buy cars. They preferred online. And then you had the trend of low interest rates and stimulus, where people could afford a ton more car and demand overall skyrocketed. And then of course you had the massive car shortage, which caused used car prices to skyrocket and bolstered Carvana's inventory. And those 3 lovely trends took Carvana's share price from $90 all the way up to $376, peaking in last August. And since that peak, every single one of those trends has reversed out of Carvana's favor, and you've also got a massive market crash. And so Carvana stock went down about 95% to $19.45. And while it has shown a bit of proof of concept in terms of a rebound rally, it's still down about 87% from highs. So in this video, I actually want to go through and answer the question as to whether or not I think that Carvana is a good deal right now, 87% off from all-time highs, and whether or not this beatdown is deserved. And we're going to get into it in a second, but first, a word from our sponsor. Last month, reports of inflation hitting 9.1% month over month sent markets into a death spiral. It's the steepest rise in cost of living since 1981, and it spells disaster for tens of millions of Americans and their savings. At this rate, the dollars under your mattress will lose half of their value by 2030. But institutions like, say, Bank of America saw this coming. They knew that equities would be crushed by inflation, which is why they recommended investors look at real assets like art, the same asset that outpaced the S&P 500 by more than double over the last 25 years. And the last time inflation was this high, it did even better, appreciating by an average of 33% annually, according to the MW All Art Index. But with Masterworks, you can invest in artists like Banksy and Basquiat in just a few taps, and the results speak for themselves. Masterworks has delivered net average returns of 26.8% to their investors since 2019. With inflation on the rise, demand for Masterworks is through the roof, and there's even a waiting list to invest. But you can skip it today by going to masterworks.art/ZipTrader or by clicking the link down below. Thank you, Masterworks, for sponsoring our video today. Now back to the content. Okay, Carvana. So I do want to start by saying that I do have some personal experience with this company. Not sponsored by them or anything like that, but they actually do have a pretty convenient process. I bought a car from them back in 2019, and then I sold it back to them actually early this year when I got the Model S, and they did a pretty good job. It was easy, it was convenient. They give you a certain number of days to return the vehicle if you don't like it, and offer warranties and stuff like that. They deliver and pick up the cars straight from your house. So overall, as a customer, my personal experience was pretty good. But obviously, a good personal experience with a business doesn't mean that it's a good business. It may be operating at a loss, right? But let us take a look at their overall numbers here. So I'm a trend guy, and I like to look at overall trends. Is the company growing consistently over the long term, and will that trend continue? This is their quarterly revenue starting in 2016. You start down here at about 73 million, and then it scales up quarter after quarter after quarter, and by 2019, you're at 1 billion. And then from 2019, from that billion, you scale up to 2.2 billion by Q1 of 2021. And then Q4 of 2021, you're at 3.8 billion. And then Q1 of 2022, you take a breather, and then Q2, you pick up to a new all-time high, 3.884. Just under $4 billion. Came pretty damn far from that 73 million that it had started back in 2016 at, right? You go over to the lovely macro trends chart. Right now, you are paying a price to sales ratio of 0.3, which is some of the cheapest it's been in years. And then it's like, okay, Charlie, great. So we already know the whole price to sales game. I'm sure glad that you're paying little compared to the sales, but what about the dirty P word? Profitability. Well, there lies the issue, of course. Even in their busiest time periods, you barely even scraped by with one profitable quarter. But now that interest rates are going up, the consumer is less stimulated, and the used car market is slowing down as a result, well, the losses are starting to be staggering, right? They are burning through cash so fast that you would think that an arsonist was running this company. And certainly if you expect we are going to be heading into a massive recession alongside high interest rates, who the hell would be bullish on a used car stock, right? The question isn't, is something bad happening, because it certainly is. But the question is, will Carvana survive and come out the other side of this swinging and appreciate to prices that are much higher? Well, to answer that question, you have to go over to their assets on the balance sheet. You look at cash and cash equivalents. You're sitting on cash and cash equivalents at $1 billion, which is solid. But keep in mind that the company burnt through $400 million plus bucks last quarter. And you go over to vehicle inventory that they have right now, you're at $2.8 billion. Now, this is a big stinking line item here. You think about what it means when you have $2.8 billion in vehicles sitting in your inventory. Vehicles usually are a depreciating asset. They're not always a massively appreciating asset like we've seen the last couple of years. So you're doing great when used car prices are skyrocketing, but what about when the opposite is happening? You go over to the CPI, used car prices are still up 6.6% year over year, but this is plummeting fast. If you looked at this number 6 or 7 months ago, it said the year over year was like 30, 40, 50%. The trend right now is in the opposite direction. 4 of the last 7 months were downtrending for used car prices, and I anticipate, and a lot of analysts anticipate, that the next 6 months, probably going into the next 12 months, as higher rates really start getting priced in, are going to be negative for used car prices as well. And you're probably going to see more and more quarters of what? Well, downtrending in terms of used car prices. And what happens when new car manufacturers start really pumping out new cars as well? Well, all of a sudden there's a lot more supply out there, and there's a lot less demand because of higher interest rates and gutted consumers. So all of a sudden you have prices consistently going down and down and down. All of a sudden you go from a huge shortage of used cars to a massive overstocking of used cars. So for a company like a Carvana, who is sitting on $2.8 billion in inventory, imagine if prices on the whole start going down 10% year over year or 20% year over year. Well, all of a sudden they have to choose either to try to discount these very, very quickly in order to move them as fast as possible, or wait for the entire market to be discounting them, where they have no choice but to discount them anyways. And if you lose just 10% of the value of a $2.8 billion inventory, how much is that? That's a $280 million loss. And obviously pretty easy to understand why that's a big problem. I'm just saying 10%, the number could actually be way worse. In fact, a lot of used cars today are still trading very, very closely to what you could buy their new car counterpart for, which obviously is a bubble market, right? But I think where it looks really, really scary is you look at the liability side of the equation. They have about $10.5 billion in assets overall, but they have $9.6 billion in debt. So every quarter as demand goes down and financial conditions become tighter, well, their inventory is going to lose value. And they are at the same time going to continue to pay dramatic debt servicing costs, to continue to use their extensive properties and equipment, to continue holding insane levels of used car inventory, to continue paying all of their employees, and also at the same time trying to expand. I don't know, folks. Obviously, Carvana stock has already priced in a lot of this, but to me, this just doesn't seem like something that I would want to be stuck with. It seems to me that if we get into a multi-year slowdown in the overall economy, where rates don't go back to anywhere near where they were pre-pandemic even, and used car demand doesn't just completely bounce after this downtrend that we're seeing, well, it seems like Carvana is going to have to take some extreme measures to either dilute or raise capital at really bad rates. And it seems like even in a year plus time horizon, they still have a lot negative ahead of them. They may have to start really offloading this inventory at a massive discount just to make sure that they're ahead of further headwinds. So anyways, my thought process on Carvana. Well, I don't like it on a fundamental business level. I think that the economy is going to be worse than people think it's going to be. I think that rates may have to go higher than people think that they have to. And I think that the used car market is going to be in a dump for a while. I think that right now it's still very, very hot, and Carvana is already not doing great. But in a year, I think it's going to be an apocalypse. So in my view, Carvana is a no. But I do think from a contrarian trade perspective, it's very possible that Carvana may actually be an interesting short squeeze candidate if it continues getting buyers. If you look at the short interests have been trying to lock in profits, suggesting they don't think there's a ton of downside left to realize, even if the used car market continues to downtrend. And if short sellers are trying to get out of their position and people keep buying it, well, all of a sudden you could get that momentum rally that people like in the squeezy McSqueezers. But from a fundamental level, which I think is what people wanted me to cover this stock on, I don't like it. I just don't like it. It is what it is. Anyways, that caps off the video. Let us know what you think down below. Thank you again, Masterworks, for sponsoring us today. Make sure to check them out with the link down below and learn more about diversifying with art. If you want to get up to 10 free stocks with Moomoo, I'll put a link to Moomoo down below. And finally, if you want to get 50% off our ZipTrader program, I will put a link to that as well. Have a good one, folks, and I'll see you in the next video.